Okay, so let's learn how the Deferred Sales Trust works. This is kind of the meat of this presentation. You got to understand how it works. You got to be educated in it, and then once you are, you have this tool. Okay. First thing to understand is constructive or actual receipt of a sale of property for funds. So Kumar, me and you are going to go back and forth. Are you ready to be work with me here?
Sure.
So this is the audience participation. Okay. So Kumar's selling a property, and let's just say it's for $10 million. Okay. And I, Brett, want to buy Kumar's property. I say, Kumar, I want to buy your property for $10 million. If I give you $10 million, Kumar, and we close escrow, and escrow sends you that $10 million, how much actual receipt did you receive of that $10 million?
10 million minus whatever the debt. Minus
you got it. Yeah, whatever the debt was, correct. With the closing cost, you got it. And in that scenario, you'll owe tax based upon that amount. Does that make sense?
Right.
Right. So, but if I come to you with a seller carryback and I say, hey, Kumar, don't do that. How about we do a seller carryback deal? You carry a note for $9 million. I'll give you $1 million down payment because you want to defer that tax. You don't want to take it all in one given year. In that scenario, if I give you $1 million down and you carried a note for $9 million, how much actual receipt did you receive?
$1 million.
You got it. So $1 million minus the closing cost would be your actual pre-constructed receipt, right. And you would owe tax based upon that number. Okay. So that's also how we maintain how a 1031 maintains non-constructive receipt. Kumar, you may just say, you know what, Brett, I kind of like the seller carry, but I don't like it as much as the 1031. And some of the reasons are you're going to pay me back probably in the next couple of years. I'm still going to owe the tax. And yeah, it gets me to first base, but really what I want to do is a 1031, meaning I'm going to have escrow sent it to a QI company, that $10 million, and I'm going to go do another 1031 exchange. I wish you the best on my deal. And that's where most deals go down, right, because of that reason alone. Because a 1031, there can be almost an indefinite amount of tax deferral, albeit certain rules to go up. But that's how it maintains non-constructive receipt or actual receipt. Does that make sense?
Right.
Okay. So understanding that, that's the basis of our structure. Okay, we're going to walk through the Deferred Sales Trust right now. The Deferred Sales Trust is just an installment sale. It's kind of like a seller carryback, okay? But there are a few nuances that make it unique and creative that make it work, okay? And take away some of the downfalls of a traditional installment sale, okay? So let's do this. Let's walk you through it and then let's talk about it. So this is the $10 million sale here. And traditional deal, again, they would sell it directly to the cash buyer. And the cash buyer away can have a lender too, it doesn't have to be all cash. And they would send the $10 million here. Again, in that scenario, they received $10 million in constructive receipt. But the client doesn't want to do that because they don't want to pay, let's just say this scenario is $3 million in tax liability. We'll just use 30%. Keep it an easy number. So instead we say, whoa, before you do that, let's jump in this trust at the same escrow, simultaneous close. Let's sell the assets to the trust for $10 million, who's going to immediately sell it to the buyer that's already lined up for $10 million, who's going to put the $10 million into the trust. Now, why would the seller do that? Well, the seller is going to get a note for $10 million. And the trust is going to give them a 0 down payment.
So basically the seller is not selling, so it is the trust which is selling, so he doesn't incur the gap, whatever the tax. Okay.
You're smart. You're smart, Kumar. You're catching on real quick, right? Because the trust bought for $10 million and sold for $10 million. So Kumar, how much does the trust owe if it bought and sold for the same price?
0.
You got it. Now, the note holder, the seller who now becomes the note holder, they receive 0 constructive receipt. So how much tax do they owe right now in this given year?
Nothing, right?
You got it. So it's in a deferral state, just like a seller carryback. Does that make sense?
Right. So how much can they defer? I mean, is there a time limit or something?
So our notes go for 10 years. Okay. At the end of 10 years, you can renew for another 10. And then renew for another 10. Most of our clients like to pay the tax the second day to never, and they can pass it on to their kids, and their kids can take their position and do the same thing.
So is this an irrevocable trust or?
It's an irrevocable trust, depending on how you set it up. Okay, depending on how you set it up, yes, it can be. Okay, and we'll walk through that depending on which one you use. If you go inside the taxable estate or outside the taxable estate. But let's just focus on this page right here. I want to make sure you understand this too. Okay, clearly, right, before we move on to some of those details. So the key is the trust gave a 0 down payment in exchange for a $10 million note to buy the property. So this first part of the transaction, this is just a seller carryback.
Right.
Right? The difference is we already had this buyer lined up right here, ready to go with $10 million. And so the trust immediately sells it. It's like bang, 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 like a simultaneous close for $10 million. The $10 million gets put into the trust. Since the trust bought and sold for the same price, it has a 0 gain. Since the note holder took a 0 down payment, it has 0 that's due right now. It's in a deferral state. This $3 million is in a deferral state. The smoke clears, the buyer goes away, and the $10 million is in the trust. And where's that? Okay. Well, Bank of New York Mellon, Charles Schwab, TD Ameritrade, some of the largest banks in the world. Your own financial advisor can manage the funds. That's where it's at. It's earning interest. So on this particular benefit, again, remember I said most of our notes will earn or net 6.5% after fees, earn about 8 over a 10-year period, pay net about 6.5. So the clients are getting, about 6.5 on 10 million, of which there's an extra, again, 3 million that they would have paid in tax. So the benefit is enormous, right? Benefit is enormous because you're getting extra 6.5 on this 3 million. So I want to focus on this page alone, though, and we'll get to more stuff here in a minute. But any other questions, Kumar, on this particular page?
No, I got it.